Kia ora koutou katoa. Good evening. My name is David Faulkner. I am the General Manager of Property Brokers Property Management. I'm joined by two very distinguished guests this evening to co-host a webinar. To my right, to your left, you'll be able to see Kris Pedersen. Kris Pedersen from Kris Pedersen Mortgages and Insurance. Very prominent mortgage broker across New Zealand, deals a lot with the investment markets. And over to my left and to your right, you'll see Ilse Wolfe. Ilse does a lot of property management or property renovation coaching. She's got a fantastic story to share, and you'll hear from both of them. I'll do a quick presentation. I'll hand over to Kris. You'll be able to put your questions in the chat box, so we'll be able to take those questions as we go and towards the end of the webinar as well. So I'm sure you'll have plenty of questions for both parties. But anyway, I'll get to share my screen. We'll get underway, and yeah, so away we go. So just bear with me until we switch over. Hard to hear. Okay, I'll make sure that we speak up a wee bit louder. I'll make sure the volume's on full belt. So thank you for that. Okay. Right, so here we go. Property investment, state of the nation. So as I've introduced all our parties for today's webinar. Now, what I'm going to do briefly is show you what is happening with rents across New Zealand. So what you can actually see at the moment, we work closely with a company called Velocity. They do automated rental valuations for us, so we can actually compare how we're doing as a rental company, as a property management company, and looking at what's happened with market rents across and see. So it gives us that data. I'm a big believer in data. We're a data-driven business. You can see the amount of properties that we've got in our books. An estimated value there of $2.7, $2.8 billion, and shown that the annual rent that we collect. That helps us with our decision making, as well as we use information that we can get. So what you can see here, this graph is from Tenancy Services. This is the rent and bond data. Now, the information that this is available to the public. You can go onto Tenancy Services website. You can download. You've got going back from 1993, from when records began. I think this graph is interesting. This is showing you the median rent for all of New Zealand. Right? And what this basically is showing, it shows towards, if you can get my cursor and I can highlight here, there's a certain spike from round about 217, and it starts to go up at a steeper rate. You can see a bit of a flat line round here, the rent freeze. That is on COVID, and then this spike, and it's continued to go up. Now we're just starting to see the line dip. If you look at the trend line, it tracks. It goes about 4 or 5% per annum rent increases. That's what typically happens. In the last few years, we've seen it increasing at around about 10% nationwide on our portfolio. And if you look at Trade Me data, it will tell you a similar story. Now, I'm of the opinion we're going to start to see a slowdown in rental growth. I understand that we see strong net migration coming into New Zealand. There's also around about 50 to 60,000 per annum New Zealanders leaving. But we've got net migration. It's about 130,000 coming in, particularly prominently from places like India, Philippines, China, coming into New Zealand. They have to go and find somewhere to live. However, I just sense at the moment, and our last month, we've just looked at some of the data from property brokers. Our rents have stagnated. They've not seen the growth. When I do our financial budgets, I've been projecting rents to be growing at that 10%. This year, our financial year goes from July to June. I'm not saying that's going to happen. I think we're going to go back more to a traditional 4 or 5% rent increase. That's my own personal view. It's not going to be like that for every region. West Coast, what I can see is looking at the data that we obtain and what we obtain through Velocity on this graph here. I can see that it is, in some cases, it's under rented, and we're still seeing that rent there going up quite prominently. It's quite buoyant in the West Coast, and there's some good buying there. Okay, but other things that are having an impact on rents, we're starting to see an increase in tenancy tribunal applications. Again, all this information, you can see where it's sourced. We'll be able to share these slides at the end of this. And you can see the first quarter, when they started to take records, over 6,000 applications are made by a landlord. The tenant applications have stayed consistently the same every quarter. You see the big drop here at the 3,000. That's because of COVID. All right, so you got the rent freeze comes on. They've put the 60 days for rent arrears, so it's hard to evict tenants. All right, and quite rightfully so, protection there for tenants. But what you've seen as the data tracks across, we're now going back to, and it's the highest quarter one. I'm going to be very interested to see the data that comes out from quarter two. I suspect it could tell a similar picture, but we are seeing more and more issues with rent arrears. That's why we've had the spike in that information there. So you can see here, about 90% of landlord applications to the tenancy tribunal are to do with rent arrears. You can see this, it's grown substantially. And I think everyone quite clearly is feeling the squeeze. So, I mean, I write in the Property Investor magazine, along with Kris Pedersen. We both contribute to the magazine. You wouldn't have been able to read it yet. It'll come out in July. But my advice to landlords is, you know, you've got to be prepared. If you've got good tenants, making sure that you are looking after them. And if you are taking a property to the market to rent, be realistic on price. I think supply is going to start to outweigh demand a little bit. There's less and less tenant movement takes effect. And make sure that that property is very, very well presented, as if you're marketing it for sale. I've got good relationships with Tommy's Property Management in Wellington. We're in a realtors network together. And what they're telling me, and data shows that the amount of listings which is now becoming available on TradeMe, typically around this time of year, it's about 600 properties available to rent. That's now gone over 1,000. So you can actually see that that is a significant spike in the market. So I'll keep an eye on the questions as they come through. I'm now going to hand you over to Kris Pedersen. Kris, the floor is yours. Do you want me to drive for you, or do you want to?
I can drive. Thank you, David.
Okay.
Good evening, everyone. So, David, Ilse, and myself was a couple of weeks now braved the cold of the South Island, and so I've taken most of this presentation from a couple of weeks ago and truncated a bit. And so, final webinars, a lot of the information can be a bit personal. So, if you've got any questions about anything, please feel free to throw it through, and we can kind of discuss it at the end of the presentation. You tell me when you're ready.
Yeah, go for it.
Okay, so quick intro on myself. Been investing for a bit over 20 years now. I kind of fell into investing when a friend took me along to a seminar around the turn of the century, and kind of became very passionate about it and been kind of doing it ever since. I initially kind of worked more in the corporate sector, which I found out very, very quickly wasn't for me. So I then worked for a small non-bank lender, which is where I learned, I suppose, how to do the more creative financing, which the banks won't do, and set my mortgage broking business up in 2007, which was a very interesting time because the world fell apart the following year. The good part about that is it's kind of given me experience for the current market, kind of seeing how to deal with property finances through a recession is a bit of a skill. Although I would sit there and say the current market and how banks are operating are a lot different than what they were back then. The banks were pretty brutal to their borrowers in 2008, 2009. We're finding banks in most cases these days, if you've got yourself in a spot of bother, they will try and help. So my business has been the main sponsor of the Auckland Property Investors Association and the Northland Property Investors Association. And as David said, I'm in the Property Investor Mag, a few pages along from him, and I write the interest rate commentary and answer the finance questions there. So I suppose the big news that's come out from a financing point of view in the last week has been confirmation around what's known as debt to incomes. And this is a new, to me, it's the biggest regulated rule change we've seen in the mortgage market in probably over a decade. Back in 2013, we saw the Reserve Bank bring in loan to value rules, which were effectively restrictions which restricted what people could borrow based on the amount of equity you've got. Now, debt to incomes is very much tied back to your affordability. So I want to have a bit of a chat over this, because while I personally think it's a little bit political, and I think what the Reserve Bank has done is trying to slide this through at the moment, where we've got interest rates quite high. I don't think you will hear too much maybe about having a massive effect over the next few months, but I expect at some stage, as interest rates start to drop, that it's going to actually have to start to bite. So the proposed rules were that owner-occupied lending is going to be restricted to 6 times household income, and that 20% of total bank mortgages can be more than this. For the investment side, this is going to be restricted to 7 times household income, and again, 20% of the total bank's lending can be outside that 7 times threshold. So if we look at a basic example, let's say you've got a 700,000 of investment debt. That means you need 100,000 household income, and so they're actually working off the gross income, not your net after tax income. In regard, let's say you had that 100,000 household income and you're looking to buy your own home. That means you could potentially qualify for 600,000 as a mortgage. Now, just note that this is not going to take over banks' current affordability rules. It's going to basically be worked alongside. So banks will still do the same testing that they've always done, and I'll show you shortly why in most cases their current testing is actually more onerous than the DTIs. So don't think that if you're looking at your numbers now and you've got a certain amount of new times that will immediately mean you qualify. Banks have got their own other outside checking they will continue to do. Now, while the banks will use your gross household income, so that's your gross income before tax if you're on a salary, or what you're getting before tax, basically if you're self-employed, they are going to use the scaled rental income. Now, this changes from bank to bank a bit at the moment. I think it'll get standardized over time and probably end up sitting around 75 to 80% across the banks.
Kris, can I just jump in there? When you're talking about self-employed, because obviously there'll be a lot of people who are like plumbers, tradies, whatever. How do they calculate the income of for say, is that over a 12-month period? Or
great question. It actually changes from bank to bank. So if you look at your set of financials, what will tend to happen is you'll have your revenue. So that's basically all of your income coming in.
Yeah.
Then your accountant's job, of course, is to try and make you pay as little tax as possible. So they're going to tend to ram as many expenses through as possible. And then you're going to be left with a net profit before tax afterwards. Now, your accountant might split that into different things like paying you salaries and things like this. But effectively what a bank's going to do is take your income basically after whatever the business expenses are, and that's what a bank will take. Now, what David was asked a really good question there is it changes from bank to bank. So we've got some banks who might average, say, 2 or 3 years financials. We've got another bank who might look purely at just your most recent year. Don't want to complicate things too much, but then we've got other situations where if you've got a good accountant, they are going to do certain things which are completely legal to minimize your tax. Some banks will allow you to add back certain things. So it's very common if you're self-employed, as an example, to write off part of your home if you have a home office. That's very usual. I set my business up from home and did that for a number of years. We've got a couple of banks who won't actually allow you to add that home office area back in, where others will. So that's, I suppose, when we'll look at it as you as an individual and try and look at your position and try and figure out which bank is going to maximise your affordability in that bank's eyes. Okay,
we've got a question here on test rates. Are you going to come to test rates on should we wait till we go to the slide on that, or do you want to answer that now?
I've got what I might do, if it's okay, I'm about to go through an example when we get into debt to incomes, where I'm going to show you how a bank is, I suppose, assessing your affordability now, and how that is going to be overlapped with a debt to income example. And I will have a bit of a chat about the test rates then.
Sweet. So fire your questions through on the chat as well, guys, and we'll try and answer as many as we can as we go. Okay.
It was a great question though. Now, I don't want to focus too much on this side, but these exemptions have been put in place for debt to incomes. The part I don't 100% know is how they're going to be used. So common sense, we sit there and we want people to be able to access business loans, because that's how we grow the economy. It's better for productivity. It gets people into jobs. And I suppose that's how we move forward as a country. The idea is that, say, something like a business loan is going to be excluded. My concern is that if we looked at the loan to value rules, which, as I said before, is the best example to see how this may play out, that hasn't tended to work too well. It's quite common in New Zealand. We've got a huge amount of people who have run small businesses and they run off their own home or an investment property to access capital to move forward as a business. We've found banks have not been that friendly at allowing them to lend outside the loan to value thresholds to access business money. So don't want to talk about this too much here because we need to see how the banks are going to actually utilize it, but there are supposed to be some exemptions. The big one they're supposed to focus, I will make comment on, is new build lending. So if we go back to early 21, we 90% plus of what I do as a mortgage advisor is dealing with property investors, traders and developers. And before Labor had made the change around the interest deductibility, probably I would say 80% of my transactions were people dealing in the second-hand market. And we saw that change overnight, suddenly purely because of a massive tax change. I'm interested to see over time how this plays out. If people can't access funding, does that mean they suddenly push forward with new builds? Does it mean that they look to use alternate types of finance so they can still access the second-hand market? We've got to see how that plays out. But effectively, this is political. It's trying to get investors to focus on increasing supply, which in some ways you could say, okay, that's a good idea. Personally, I look at the Reserve Bank who's implementing this, and they are getting political, and they're going outside their mandate. Their job is, in my opinion, to control inflation, and you only have to look at the state of the economy to go, they've not done a very good job of it over the last few years. So I think they should stay in their lane. So a bit of a client example, and I thought this was the best way, rather than just continuing to throw theoretical numbers at you. I kind of showed you how a bank looks at an investor today and how they may look at that investor in the future to show you how debt to incomes may play out. So we've got Joe and Mary here, and they've got 110,000 gross combined income between them. They've got their own home, which has got no mortgage on it, and they've got a couple of rental properties with $1 million of debt on it, and they rent those properties out for $1,000 per week. Now, this here is how a bank would run their affordability kind of as sort of calculated today. If you jump on any bank website, they've got mortgage calculators. They don't work properly. They're more sales tools designed to try and drag you into a bank. We've got access to the actual kind of calculators they tend to use behind the scenes. So if we look at Joe and Mary's, I suppose, position through a bank size, what they're doing is they tend to look at everything on a monthly basis. So what we've got here is their net monthly income. And then on the rentals, they are taking that figure and they're scaling it. Now you'll see there, that's 88%. As I mentioned earlier, we've got banks using differing amounts, and I think that number will probably standardise around 80% over time. So we've got Joe and Mary's net income, the scaled bank monthly net income, and so we've got this 11,273 figure, which is what the banks are taking as a allowable income figure. They then take away living expenses, and what they do, and this goes back to the fantastic question that was just asked before about test rates, is the banks don't look at what you're actually paying. So let's say you've got, Joe and Mary have got their $1 million, and they may still have a rate of 4%. They may be on a current blank floating rate of 8.5%. Doesn't matter, because what the banks are doing is they're using these test rates, and these test rates are going to be higher in reality than what Joe and Mary's actual interest rate is. So at the moment, the test rates for the banks are around about 9%. And even though as investors, we often tend to have our debt on an interest-only basis, the banks will tend to assess everything on a principal interest basis. So in this situation here, what the banks are doing is they're taking that $1 million, they're assessing it on a 9% P&I basis. And as you can see, by the time you've thrown that through a calculator, it's about $8,047 per month. So what we're looking at here at the moment, if you look at the income again, 11,273, we look at that, that's the income, take away the total expenses, so that's living expenses and mortgages through the bank calculator, combined of 11,547. That's basically saying Joe and Mary, through a bank size, is running at a deficit, i.e. they cannot borrow any more money, because that seemed to be, they don't have any surplus income left over for that.
So, Kris, can we just ask a question here? Does this mortgage term, does that affect the percentage? So if it's a 10-year mortgage or a 20-year mortgage, or does that, can you extend your mortgage to get your payments down? So,
great question. So the term of the mortgage does not change the test rate.
Right.
But the term of the mortgage does. So because it's assessed on P&I, so really good question, David. So as an example, what we're seeing, and I'll try and answer this as well as possible, we're seeing a lot of cases, especially with investors who have accumulated substantial portfolios over time, who have rolled over interest only for again and again and again. And so I'll give a quick side comment about Joe and Mary. Let's say they took their $1 million out 20 years ago and then originally borrowed on a 30-year term. What the bank would actually be doing here is they'd be assessing that $1 million on the 9% test rate on a 10-year term.
Right.
Joe and Mary might actually have that $1 million on, let's say as an example, it was on 6% interest only. $1 million, 6% interest only is $5,000 a month. Now, I can't quickly do the numbers in my head, sorry. It's a bit more complicated, but I can sit there and say, let's say they only had 10 years remaining on the term. It's probably going to be something through the calculator like $12,000 a month. So big difference between $5,000 a month Joe and Mary would actually be paying and $12,000 what the bank would be calculating as. In that case, while they can't change the test rate, only the bank could do that. They could extend the loan term back out to 30 years to bring down what the bank's view of their monthly payment would be, which would improve their affordability.
Right. How flexible are the banks being at the moment? Are they being helpful? What's your opinion on that?
So I suppose I look at this if I can compare this back to the GFC, because that's the last time we had a decent recession. And it couldn't be any more different. So in the GFC, I strongly remember taking really strong clients who maybe not dealt with a particular bank before to that bank, and the bank saying we don't want to deal with them. And that's because the bank's balance sheets weren't in good shape. They were running short on cash, and they didn't really have any appetite at all to do anything. At the moment, while the market's recessionary, the banks actually want to lend. They've just been over-regulated. So the bank's positions is actually pretty strong. So what this is a case of, a lot of people are going to struggle to borrow because of the regulation, but you can't necessarily blame the banks. The banks would actually like to have less regulation on them so they can move forward.
Okay, good stuff.
So moving forward with Joe and Mary, kind of where they're at today, they can't actually kind of borrow anymore with a bank. Let's have a bit of a look on the debt to income situation, how that would play out as of today. So keep in mind what we said before. They've got that 110,000 gross income. They've got the annual rental income. We scale it, and so by that stage there, it's about $46,000. We combine them together, and we've got about 156,000 in total, so 155,760. Now, you may remember earlier on, we can effectively take that total income and times it by 7, which means that Joe and Mary's total borrowing capacity would be just under the 1.1 million mark. Keep in mind, they've got $1 million of debt. So through DTIs, this actually means they could borrow more. So DTIs are saying Joe and Mary have got more borrowing capacity. Standard bank affordability criteria saying they cannot borrow another cent. So in my opinion, what you're going to see probably over the next little while is going to be that debt to incomes aren't actually having much of an influence. And I personally think there's a political bent. This is why the Reserve Bank is pushing this through at the top of the interest rate cycle. And got a question here: has the scaling by banks been confirmed of rents for DTIs? No. So this is where we've got differences all over the place in regards to what banks are taking. I do expect it to maybe be standardized around that 75 to 80% mark. We've got two big things happening. We've got banks who are rearranging the percentage of rent they can take now that there's a removal of the interest deductibility. So we had a stage where banks were taking far less because they had to take into account that people couldn't write the interest off. Now we're going back to a market where they can, and we've got this debt to income thing coming over the top. So I've not heard of the Reserve Bank coming in and telling the banks what they have to do, but I think you'll end up with a number somewhere in that 75 to 80%.
Right, we've got a few more questions coming in, Kris. You want to deal with them now, or do you want to wait till the end?
Far away.
Okay, so Clinton, he's asking that if income is from a job, right? Is that taking? I think what he's asking there, is it just salaried income?
Well, it's any type of
rental
income. So I'll try and answer this as well as possible, because this is where it's going to get interesting. So banks, we went through the self-employed example before, where different banks may look at self-employed income differently. This can also apply to salaried work. So as an example, it's quite common in a whole lot of different roles for people to have a base income and then maybe have some type of commission or bonus income on top of that. There's big differences from bank to bank and what they'll take into consideration. A lot of banks will scale bonus income down to say 80%. What we're starting to see behind the scenes, because the banks are not wanting to be more regulated, or they're seeing that it's going to cut off their ability to do business, we've seen some banks say, we want you to still provide us with this information. And while they may not, how would I say this? If the debt to incomes become more onerous, they might become more relaxed on some of these other little areas they can tweak. The question is will the Reserve Bank try and regulate every single bit of income and how it's calculated? And I don't know the answer to that yet.
Okay, there's a good question there which has come in. Will New Zealand banks loan to New Zealand citizens overseas?
Yep, I've got a pretty strong client actually in the UK I'm doing a mortgage for at the moment. I've got a stack of clients I'm doing mortgages for in Australia. I've got a client in Singapore I spoke to last week. The part which is worth noting on this question is what they will do is they'll tend us to so you use the UK as an example. What will happen is they'll change it from pounds into New Zealand dollars, and then depending on the bank, they'll scale that income. So we've got some banks who'll wipe off 40% of the income for exchange rate risk. Obviously, that bank's going to be pretty hard to qualify for. I've got another bank I can think of immediately who will only wipe off 10% for exchange rate risk. So yes, to answer your question, but some banks are a lot better than others. Some banks are difficult because you've got to be in New Zealand to open the bank account. So it becomes pretty expensive to cross the world for the bank account opening process.
All right. Well, we'll move on because we're on the clock and we've got Ilse waiting on the wind. So we'll carry on. We'll leave the questions.
So going back to what we're talking about, test rates, and someone asked that test rate question before. What's happened over the last 5-6 years? If we look at the pink and the blue line, that's been kind of real 1 and 2 year fixed rates. These black dots that you're looking at are the different test rates that banks have used over this period of time. And if you look to the top right hand side, you'll see those test rates trending up. So that's kind of where we're at the moment, where we've got those test rates sitting around 9%. Don't have too much time to focus on it tonight, but in my opinion, we're top of the interest rate cycle. I'm expecting interest rates to start dropping back end of this year going into next year. And as interest rates drop, the test rates will all drop down as well.
I think there's a lot of people relieved to hear that.
Yes. Yep.
Yeah.
I'm hoping the Reserve Bank does it sooner than later. Otherwise, they're going to have some pretty negative implications on the economy. Now, what I want to show you here is Joe and Mary's position in the future. And obviously, we don't know how it plays out, so this is a bit theoretical. But let's say they've had a bit of a pay rise. They're now up to 120K combined income. They're still in a situation, they've got no mortgage on their home. They've got the same amount of debt before because they had it on an interest-only basis, and their fantastic property brokers, property managers have managed to get them some rent increases. And so they're getting another $200 per week and $1,200 per week in total.
Thanks for the plug there, Kris.
Had to give you a nudge, Dave.
Well done.
So again, this is looking at a bank calculator, how a standard bank assessment would be. We've got the Joe and Mary's net income, the bank scaled rental income, and so they've now got 12,604 income they can use per month for income purposes for passing a bank mortgage. Take off the living expenses, and we've suddenly got a big change because interest rates have dropped. That $1 million is now being assessed at, let's say, 6% rather than the high 9% it was previously. Suddenly, that means that the monthly payment in the bank calculator goes down to $5,996. And when we take the total income minus total expenses, we have a surplus at the bottom. So this is that green $3,108. And without complicating things too much, roughly that means that that client could borrow another, say, $550,000 based on those numbers. So depending on their target area, that might be enough for them to go buy that additional rental property. Now, let's see how that translates, though, with the debt to income rules overlapping it. And just want to remind you that when we looked at it previously in a high interest rate environment, that they could borrow more based on DTIs. They couldn't borrow anything else based on the current lending criteria. Now interest rates have dropped, normal lending criteria, they can borrow that $550. So DTIs, they've got the 120K gross annual income. Add on top 55,000 for the scaled rental income, means that we're sitting at about 175,000 for the total income that can be used on the DTI formula. We times that by 7, and that means they can get to a maximum debt figure of 1.224 mil. Keep in mind that on the normal bank formula, they can borrow about another 350,000 on top of that. So you can see here quite clearly as rates drop, the DTI formula is going to come over the top and become more of a hurdle to get through, shall we say, than the normal bank affordability criteria. Now, some of you might remember, obviously I was throwing a whole lot of numbers at you, but towards the start when I was putting the basic rules in place that have been posed, there's going to be about 20% on top of, or 20% over the 7 times threshold that banks can do. The question is, I suppose, how they're going to look to utilize that. And DTIs are definitely going to be exceeded as rates drop. ANZ did some pretty good investigation. What we're looking at here on the graph on the left is the percentage of lending which has been done to owner occupiers with a DTI above 6 times. And investors, sorry, the graph on the right is the percentage of new lending to investors with a DTI above 7 times over the last kind of 5-6 years. This line in the middle is the 20%. So going back, banks are going to be able to do 20% of total lending on each of those thresholds above either 6 or 7 times. Because if you're looking at it now, if we take out a pretty crazy market in 2020 and 2021, we had a very, very low interest rate environment. I don't think these DTIs are actually going to hit the owner-occupied market or first-home buyers that much. If you're looking back at kind of that 2018 to 2020 mark, you can see there that it's quite clearly below. On the investor side, I think it's going to be a much higher hurdle to get through.
Okay, all right. We've got some questions, but what we'll do, we'll deal with the questions at the end. If we don't run out of time, we'll make sure that we email you, because we've got who the questions are from. We'll make sure Kris answers those specifically. So please don't get too obsessed if we don't get to your questions.
We'll make sure we get you answered. So final DTI points. The final rules were signed off in the last week or so. A lot of people put submissions in. The property investment associations put submissions in. I know another party well who put a submission in. The New Zealand Banking Association put submissions in, all requesting more relaxed investor rules. The main request that was that the 20% amount will be at least 30%. The Reserve Bank, I think, just were never planning to look at anything else. This is going to get implemented 3 weeks from next Monday, 1 July. And at the same time, I suppose a tiny bit of relief is at the moment, the maximum you can borrow on second-hand investment properties is 65%. That's going to get increased to 70%. So if you're a bit short on equity, that's going to give you a bit more leeway there. Now, quick recommendations, I suppose, before you borrow further is to probably get a review so you understand. You've got to be careful at the moment. I mean, I personally think we're coming into some of the best buying time that we've had in the last 10-15 years. Unfortunately, there's a lot of people who have overexposed themselves probably in a lower interest rate environment of 2-3 years ago, and people are going to have to sell at discounts. There'll be some of you who are potentially listening who have got the ability to buy, and you know the power's in your hands because it's very much a buyer's market over the next kind of 12 or so months. Don't just rush out though, because you don't want to become one of the people who then has to get into a forced sale a little bit down the track. Consider getting a review, and there's some different things that you should look at doing maybe before you take on more debt. I won't focus on these too much now because of timeframes, but I mean, just suppose really quickly, review your current borrowing from a finance point of view. David himself actually asked a question about extension of loan terms. If interest only is important for you, you want to make sure you're going to be able to continue to access that. And so check that. What you don't want to do is take on more debt and then find out that your interest only debt all gets converted to P&Is. And if you're equity rich, there's certain things we do where we kind of encourage dropping out securities so banks don't hold all of your assets. Another thing we see a lot of investors who own a number of properties is they get caught in what's known as a one bank trap. I've got an ebook which will explain the pitfalls and I suppose also the ways to set yourself up in a lot more detail. So if you jump on our website, you can download that. And there's also a chapter by a well-known property accountant, Matthew Gilligan, where he's explaining it from a structuring and accounting point of view as well. Just a quick story on that to finish off, because a lot of people develop portfolios with one lender, they think it's fine, and then they don't realise until they've got themselves into a bad situation how dangerous that can be. And when I was preparing for our little South Island jaunt a couple of weeks ago, I actually found this slide and it brought back a story of some people who got caught badly, I suppose, the last decent recession, which is the GFC. And this is a complex called Beaumont Quarter in Auckland. If we go back to when it was sold, it was effectively sold off by some dodgy property spruikers. Some of you might remember the name Blue Chip. And the average apartment was sold for about $450K, and it was leasehold, so that means you own the apartment, didn't own the land. And a couple of years after settlement, the ground rent went up about 400%, and these little puppies went down in value from about 450 down to about 80,000. So not the most attractive investment. And I vividly remember over the course of a couple of months having a couple of different investors come in to take advice. And first person had about half a dozen investment properties, all with one bank. He was a tradie. Business had gone a bit slow. He was struggling a bit, so he bowled into the bank manager, said, "Look, I'm struggling a bit. What I'm going to do is sell down a property or two. It's good for you as a bank, and it's good for me because I can get my hands on some surplus cash, which will get me through the recession." The bank said, "We love the idea of you selling down a couple of properties, but any of the surplus cash we're going to take." And because of how they cross-secure the mortgages and the securities behind the scenes, that's pretty much what every bank in the market will do. Client number two, the way he'd funded it is he'd borrowed 20% of the 450k purchase price against his home with one bank, and then he'd approached a second bank to provide the remaining 80% or 360k lending, and that second lender had taken the apartment as security. As the ground went flying up and the property value went flying down, they started to put the squeeze on him because they didn't like the fact that they effectively had a large mortgage on a property that wasn't worth much. Now, we were able to refer him off to a lawyer to get some advice. I won't get too technical on the advice there, but while obviously it was a pretty horrible investment purchase, this guy's cash flow was okay and he wanted to be able to keep buying. So he ended up basically going to that particular lender and saying, "You've got two options. You can bankrupt me and all you'll do is lose a whole lot of money, or you can bugger off and I'll keep paying my mortgage and we can move on." And the bank actually decided just to sit on the sidelines and let that guy continue on with life. Now, because of the way he'd set himself up, well, we were able to go back to the existing bank, which had his home and he had more equity in. We were able to then set him up for further investing. So hopefully that's a quick little idea or quick little concept of why split banking is a great way of moving forward. It gives you a much better position of continuing to grow your portfolio, but it also keeps you safe in times like now. So I'll throw this over to Ilse, and if you've got any questions later on, happy to answer them.
That's great stuff there, Kris. We'll just move over. We'll jump out of your presentation.
Fantastic. Just while we're crossing over, because I do have one thought that I feel could be top of mind for a lot of investors. These changes come into place in the next 3 weeks. Let's say someone has a conditional bank offer over that cusp. So at what point are they safe with their offer? Is it a conditional, an unconditional, or do we need docs out to solicitor to be safe with the previous offer prior to 1st of July? Is that something you can answer?
Really good question. So at the moment, I don't think anyone's going to have any issues because I think what the banks will do is use some of that 20% allotment if they need to just to satisfy settlements and things like this. I think the Reserve Bank learned because when they initially put the loan to value rules in, they caused a huge amount of damage. People got approvals pulled off them. Settlements were basically caused a lot of crap. It was a lot of crap.
Yeah.
I think they've realised that that's just completely unfair. You can't have people applying for mortgages under one set of rules and then pull the rug out of them for settlement. So I don't expect the DTI rules to cause settlement issues in the next couple of months.
Okay, that's good. Cool. Thank you for that.
Okay.
Got long arms.
Got long arms, but I'm sorry, our cable doesn't quite reach. So
right, no,
I can drive for you. Just tell us when to click. All right.
Thank you. So I'm Ilse Wolfe, founder and director of Wolfe Property Coaching, as Dave and Kris have said. This is potentially the first time you've heard of me. So just in case that is the case, I want to be the person who has been in the naughty seat in the eyes of the mortgage broker or Kris, and literally have a story I can tell there, but have learnt a thing or two over 17 years of property investments. And I want you to focus on what you can get out of me as opposed to who I am. So what I'm here to help you understand and seek opportunity in this very, regulatory changing property investor market is how to supercharge your rents through renovations and targeted value add strategies so that you can drive yourself in as much of the control seat as possible towards your ultimate property goal. So whether your portfolio goal might be 5 properties or 5 million net equity, what I want to hopefully help assist you with is take all of the opportunity from what Dave has said, from the rental data, what Kris has said in terms of what the market is, how the market's changing and what that can mean for you and your income, and basically pull that together into a strategy, which is the core of a trademark strategy that I teach for my investors. And I believe it is the sweet spot to get the best of all the property benefits, right? So leverage, manipulating existing builds to increase servicing, and also to raise a deposit or at least add value to buffer from the risk or mitigate market decline. And all of the above have happened. So hopefully you can learn a thing or two here.
Okay, there you go.
And as I say, it's not really about myself, but I've been an investor for 17 years, have done things okay, then horrifically the wrong way, and I've come to this place where what I teach and how I continue to drive my personal portfolio, both in New Zealand and abroad now, is using the BRRRR strategy, which is the buy, renovate, rent, refinance, repeat. I'm all about buy and holds and how to increase the cash flow or returns based on all those hard knocks and lessons I've learned. What I can definitely say from experience is that there is lazy debt and there is hard-working debt. And I'm all about constantly questioning myself in my life stage or journey as a point of reflection as to, if I have this current portfolio, I bought them on the merits of that they had at the time, but to continually think, is this the right strategy, or are there still the right properties that are serving my future goals? If I were to sum it up, I'd say the old school way of property investment was looking to buy where you live so you can drive past it on the way to work.
Yeah.
Right. I want to help those who are looking to buy based on the data and the numbers so they can stop going to work one day.
Yeah. Okay.
Really brief circle of life. On the left is the house I grew up in New Plymouth, Taranaki girl. From really typical beginnings, went to an amazing community school called Marfell. It was a decile 1. I had no real financial literacy that came out of the back of that program. And as I moved into my corporate world, actually similar story to Kris, worked out that was not really making my world rock. I could get my main bank paycheck to work 3 of the 4 weeks of the month, and for 1 week I was freaking out about how to pay my rent at the time. But the fortunate thing was, and it takes one person to give you that light bulb moment, I was very lucky to have an accounting client who showed me the good old profit and loss depreciation, how to get rent, supplement income, how to do it in a way that you get some benefits and that would actually aid your 9 to 5 income. Ultimately, what I teach now is going to add on top of your income, and ideally over time, the benefits of property being long term are that you want to see the dependence on your assets create income so that you can relieve yourself of so many hours. I now coach investors on a renovations focused strategy, having gone through about 17 years of DIY, hard knocks, and trying a whole bunch of things.
So you've said that you've done about, what, 200 renovations?
Yeah, between my own and my clients, we're well over that now, actually,
Really?
in counting. Yeah.
And we can see from the previous slide that you're quite happy to get your hands dirty and
Yeah.
get in there. And so you've got first-hand experience as well.
Yeah, and I guess I'd say limited but technical experience from getting involved in mucking in on those first ones. And actually that led to this slide, which is where I thought I knew everything about how to build on a renovation strategy, create a new deposit and move forward. Just so you know, I recently ran a quick poll on my social media database, and I can tell you 80% of investors, or 4 times investors, are most in need of higher, stronger cash flow now than capital gains. I would say capital gains is an absolute luxury to care about right now. Everyone in their home right now, including yourself, are probably thinking, I know I have a property that's not quite right. It's not the time to sell it, but when I do, I want to find something better to replace it with. Or if you're the lucky one sitting there thinking, hey, I have lending ability, how do I best invest that to get a stronger cash flow? The last time I sat in this office, which is Kris Pedersen's office, it was after purchasing the 3 images you see there. 3 central Auckland properties in a 6-month succession in 2015-16, where I thought I knew everything from being on the tools, did not know a thing at all about income, which is actually the most crucial part of this update, debt to income. It's not only your salary, it's how strongly the incomes from your rents will also support the growth of your portfolio towards your ultimate goal, versus a lazy debt where you're potentially not knowing really how to run the rents or outcomes of a property and getting yourself on the strife I did. I walked into here in 2016, and these 3 properties, the top up, so on top of the rent, to keep the bank off my back and my one bank trap back then, I walked in here and I said, Kris, help. These 3 properties, my top up was $55,000 per year. And as a young family with a newborn, it basically translates to, I was full-time renovating, my husband was working, he was going to work for five months of that year so that we could just pay the interest-only top-up on these 3 properties. So for me, this visual is incredibly powerful. I'm really glad to not be that same person coming in this office today, because what you need to learn is to get out of that sort of situation, and ideally not be that person saying, hey, help me with that.
Well, it's great that you can share your own personal experience and what you've learned from. We all make mistakes, and you've actually, turned it around full scale, and now look at you and look at what you're doing. Great stuff.
Exactly.
Yeah.
So I guess where that's landed is in terms of strategy. I've just to highlight here really briefly, this descending amount or cost of top up on a mortgage. Land which has no immediate income off is very costly. Existing builds with no renovation, buying a 3-bedroom house, taking an average 3-bedroom rent, adding no value, you're basically buying in a market rate for an average asset, and you are then at the mercy of the market valuations. If it goes up, great, you make some value. If it comes down, you've actually lost some of that deposit you've been working for. Right. Hands-off new build. Lots of benefits. I'm not sort of focusing on those for tonight, but definitely low maintenance, builder warranties, all that good stuff, turnkey, hands off. There are some great benefits there depending on where you are in your investor life cycle. But similar to existing builds without renovation, in that if the value comes down, especially if you bought in 21 onwards, you're possibly looking at a debt that is the same size or more expensive than the value of the property. This is a risk where I see, we talk about negatively cash flowing properties being expensive. The larger risk or the larger expense is if you cannot hold on to that property. So it's another reason to look at how can you buy a property that is going to provide the strongest income, again, to support the changes that are coming into effect. The bold section is clearly where I play. So to buy existing builds, renovate, cash flow hack, which is a trademarked renovation system I have, to manipulate the dwelling, buy a type of property. It's not all, some that you can manipulate to add massive value and rents to. Add value, so you're creating a value buffer. So say you purchase a property for 500,000, you spend 50 grand, value's up at say 650. You've created a $100,000 value buffer. If that market comes back by 50,000, if that property comes back, you've lost value, not your original capital. As Kris said, high interest rate environment, high test rates at the bank, high cost of living basically, and interest non-deductibility in the last few years for existing builds. The graph to the left really shows you an actual table from an existing build that is bought without renovation. The brackets show negatively geared property. You could easily be looking at number of properties equals this amount of top up on top of the mortgage, the rents per property. The most important thing is that it's not capital growth that pays the bills, it is cash flow, right? And when you don't have it, you can't pay those bills. So that's what we don't want. How we add value with the system is standalone properties. We manipulate the right types of builds, standalone, home and income, and multi-family or multi-income blocks of units to achieve these types of results. And this is, by the way, on assuming 100% debt. However that's split, you might have your deposit as usable equity against one property and then the purchase property. But the renovation, I'm assuming, is also debt. And this is how we standardize, how we compare apples with apples, how strong a purchase may be compared to another. Now, this is what you can expect, and this plays out in all of the purchases my clients aim for. It gives us a benchmark to work through, but these don't just turn up in the market, they have to be created. Lazy or hardworking debt, I guess this is a nudge to come back to debt to income ratios. If you go back into Kris's office and say, I'd love that extra $550,000, if you tell them that your rental portfolio is performing at a 4% return, that's your annual rent divided by the debt, is he more likely to be able to help you along with that additional lending if those properties are on a 4% return or an 8% return? This is the hard lesson I learned about 8 years ago. So little graph here, grid here, top left, standalone properties, just to illustrate when I say that, that's your classic 3-4 bedroom house, perhaps sometimes 2 bedroom, great freehold piece of land that's intensifiable, developable. Down to the bottom quadrant is a home and income example. These are mostly my properties as examples. Up top, we have a 4-bed, 2-bath house. Underneath, we have a minor dwelling. So that's a home and income. You have a major and a minor. 2 incomes, 1 title. Higher efficiency of returns. Costs a bit more, but the sum of those rents really helps your servicing if you do it well through renovations. The other images, 3 to the right, are all multi-unit. So we're looking at 4 or 5 or 11 incomes in these examples. These are multi-incomes, and when you buy multiple dwellings on one title or a couple of titles, the returns are phenomenal, double digits when you renovate them accurately. Cash flow impacts your lifestyle. On the left is these are actually the same property before, renovated, and after. So the takeaway here is if you buy that typical existing building, you don't renovate, you're topping up about $30,000, at least on this one. However, I'm going to show you how you change your circumstance to this graph. So if you have a property that may be able to be transformed in this regard, think about how you might run mentally through your portfolio and think, how do I affect this result? Or if you're on the market to buy, this is the way you go.
Can I ask a quick question before you get into it?
Yeah.
I mean, in terms of when you've got to do your renovations and you look at adding, like you're showing some of the multis, there's got to be a bit of due diligence here and making sure that, you know, if you've got to add on a bedroom, that you're complying with the building code, you're talking to local councils.
Yeah.
You know, so what are the things that you shouldn't be doing when you're looking at doing stuff like this?
Yeah, that's a great point. So sorry, if you're not too familiar with the strategy, cash flow hacking is buying an existing build, the right address, the right property. I'll help coach you on that works to fit an additional bedroom by converting some of this extra space. We find it in different places depending on the layout and the size of the place. There are ways to cosmetically, so non-structurally add bedrooms. This is a fantastic way to add value. If you buy a 3-bedroom house, but you get a 4-bedroom rent at the end, you are distorting an above average return. This is how you're increasing the return so that you can try and push yourself forward rather than handbrake yourself. Everything that I teach, and every project is done to the code or done correctly. I'm helping the strategy, educate you on what works, what doesn't work, what to look for, physical attributes, what is going to give you the maximum existing build benefits if you're going that direction. We will always involve our third-party professionals in power team, builder, electrician, plumber, property managers, draftspeople. Everything is done correctly, but even within that is a massive playground of hacks. I'm all about the hacks. Fast, cost-effective, ideally no or minimal red tape.
Yeah. Okay. Good.
Cool. And don't tell me we have to choose between yield and capital growth. We want them all, okay? So, so here, this is through adding value, renovation flowchart, a really basic way to explain. We look at renovations that are 5, 6, maybe 7 weeks for a standalone house, really finely tuned. The power teams know if you say, hey, look, can you come along to this standalone house? They know precisely what you're looking for. They'll actually find the room for you. Obviously, the faster the renovation, the lower your holding costs. What I want to show you is how to supercharge your return. So what it is not is buying that 3-bedroom house and taking in your average 3-bedroom rent by not adding value in some way. This is purely buying an average return. You might be lucky to get a 5% return. However, what we want to achieve, if you do go that way, this is the first graph that I mentioned before. Your top up is about $330 per week in this example. However, if you then decide to convert to a 4-bedroom rental with the right property, this is how you create 8 and above average return. There are different attributes, different hints when you walk through a property as to what you could do to bring it up to an upper quartile rent. There's so much opportunity out there. It doesn't have to cost an arm and a leg, but you can follow the look and feel of new builds to compete at the upper rental market level. Opportunities here with this particular property, and this is very typical of what is out there in the existing build listings, so keep an eye out. Unconsented verandas, rundown condition, heaps of opportunity to get to the upper rental band when you address it. Old kitchen, bathroom, some of the obvious visual things. And here we're always looking for a specific ratio of what's the floor size and the number of bedrooms. And then the other aspect is what is that layout? Now, given everything you do with a renovation needs to be appropriate for two things. One, what is that location, whether it's the street or the suburb or the city or town, and also who is your most likely tenant. You know, so this kind of conversion is not going to necessarily fly in Remuera. The fourth bedroom coming off the lounge may not be what they're going for, the vibe, but in a really high demand rental market, this is absolutely great for larger families where they're basically looking for an affordable but modern, comfortable and cost-effective rental that is like a new build but probably isn't going to cost the same. This is the after, and this renovation was about $65,000, full cosmetic and converting. The bottom left is where the old dining room we cut off from the kitchen. Actually, the oven was in perfect working order. Lovely red oven. We actually kept that because there was nothing wrong with it. Behind that wall is the bedroom. So these numbers are really a true example. This was actually a last year example, but it's exactly what we're maintaining in key regional centres right now. So if you take this illustration, purchase price $415,000, I won't go into how we negotiated, but it's a really great deal for this property in a very sought after location, which was the bonus. Rent beforehand and after, as you see. This makes the difference between a 5% gross yielding rental. For that extra effort, pulling in the power teams 6 or 7 weeks later, that's an 8%. So if I come back to Kris and say, hey, look, I want to recycle and go for another property, is it the without reno or the reno in terms of income scenario that's going to help support my application more?
I so think this is the way that people are going to have to move forward as well.
Yeah.
I was in a room today with some investors, and the way I love they put it is they sat there and said, you've had people, I would say, who invest passively back around that 21 market, which is they buy new builds and just hoping on capital growth.
Yes.
I don't think you're going to do that well as an investor in the next few years if you're just buying something which is you've got to be you've got to be active. You've got to use, like I love Ilse just said that, if you're buying a 3-bedroom and getting a 3-bedroom rent, you're just going to be running straight into a brick wall with your investor.
Yeah.
If that makes
You've
sense.
got to get creative, haven't you?
Yeah,
That's right.
100%.
Yeah, that's right.
And you can't do this for new builds. This is all really.
Yeah.
And that's the thing. You have more control by having a property you can add value to, rather than take on, the new build you're settling with, and then, okay, look, I'm trying to exit. How do I add value to differentiate? I can't even landscape. It's landscaped.
Yeah.
What do I do, right? So the table on the right is the contrast of the left, which was the pre-reno. So, a small top up initially. However, break even is around that year 2 to 3. And what I am seeing with my investors now on a standalone property basis, we are roughly neutral. So with any reduction in interest rates, let's say end of year, basically a cash flow hacked property is neutral to slightly positively geared. When's the last time you heard the word positively geared, by the way?
100%.
So just a quick illustration as well, because Dave's team with Property Brokers in Palmerston North and a client of mine have actually created an amazing result, and it's a great illustration of a home and income. So just a really brief introduction to this concept, where you have a major house and then a granny flat or a 1 or 2 bedroom unit at the back. Incredible buying, 569 in Palmerston North, was a 3-bed plus 1. In this case, we didn't need to add bedrooms based on the appeal and uplift purely created through the cosmetic changes. And actually, the big juggle there was deciding whether the double garage went with the main house or the back. And we were able to get a greater total rent by making the right decision. What you're looking to get, and this was leaning on Bridget and the amazing team there, this property would have been actually, this is a good testament to a home and income, 6.3% gross yield before we touched it. That's still stronger than a standalone, but you have to pay a little bit more generally. Through adding a bit more effort and a little extra debt for the renovation, this climbed to about an 8.5% gross return.
It's fantastic.
Oh, and it's the thing, doing what is appropriate for the location and leaning on the expertise.
So I was going to say the local expertise can help. They know
Oh.
what's happening in the marketplace. They know
Oh,
what it's
absolutely.
going to do. So yeah.
Absolutely. And actually taking the feedback and tweaking the design or the spec to what the property manager, where you have that kind of relationship, advises you. So we knew that in this case, for just as a quick example, we could give the garage to this unit, which is a photo of the back unit. It's a 1-bedroom studio. That was going to go from, it went from 380 per week to 430 purely by giving it the double skyline garage. And then we were taking about a $10 or $15 hit on what would otherwise be the 3-bed house if it had that garage to when we removed it. But in future, they will add a concrete pad to the front and then boost it up for off-street parking.
Right.
So the sum of the parts ends up greater when you make the right decision. I won't go into detail here because of time constraints, but if you happen to have the luxury of a larger deposit or usable equity, and you're able to look at that higher price bracket, sort of 750K up to $1 million, this is where you really get more compounded effects of benefits of multiple dwellings that you can renovate and improve to get double-digit returns. But that's more of a build your portfolio with the first 2 examples, and this is an aspirational example. This we're not talking about tonight, but I just thought I'd say, hey, look, there are a number of creative ways to get to an 8% return. Doesn't have to be like that first example. There are so many ways to skin the cat. That's part of the fun of cash flow hacking. In this case, we took this 2-bed, 1-bath house to become a 4-bed, 2-bath in 5 weeks. None of it needed consent. It's another example of how you can truly get the results you want if you put a little extra effort in. That's basically me.
So Farnham's asking questions on special prices. If he has a 15-minute consultation, he can try and negotiate with you, can't he, by the looks of things? Anyway.
Yes, yeah, for sure. First step would be to work out if what I can provide or teach you is going to suit your goals. If that is going to be achieving higher returns and you're looking to be in control of your portfolio growth, more so than being a passive investor, then let's have a chat.
Okay.
If I can just throw a quick finance comment on the top of that as well, is that some of you might be looking at this and interested to get into kind of what Ilse is talking about there. But if you're aware of the loan to value rules, thinking, well, I don't have a 30 or 35% deposit, keep in mind that there are some non-bank solutions we're using more and more where you can get in with the same, say, 20% deposit you're getting into with the new bull market. And because you can create so much equity with the strategies that Ilse is talking about, so you can get in, use a non-bank solution, and then refinance back to bank after. So don't immediately think that you always have to have 35% to make these deals work.
All right, we had a question before from Marty, Kris. I'll just fire a couple of questions, and then because we've gone over time by 15 minutes, but we're okay. We've still got a good number of people here. So Marty's asking, does I think he's referring to the lending with mortgage brokers and sorry, with the banks. Does this apply to mainstream banks or second-tier lenders as well? I think he may have been referring to, is it the DTIs there? Or?
So DTI, so you'll find all of the banks, and there's a large amount of the non-banks are actually captured because they actually get their funding through the banks. So you'll find lenders like Resimac, some lenders like Basecorp, number of lenders there. They're actually institutionally funded through our main banks. And if that's the case, they're going to get caught. There are non-bank lenders who get their funding either through private means, offshore funding lines, etc., who they fall outside the Reserve Bank remit. We're in discussions with 3 different non-banks now doing quite a bit of work to try and create investment products over the next 12, 24 months to try and get around these rules. So it depends on the non-bank lender.
Okay, all right. Well, guys, I just want to say to you both, Ilse, thank you so much for joining us. It's been great having you.
Thank you.
Again, we had Ilse down on one of our investment nights in Invercargill, and yeah, fantastic time. And Kris, again, thank you. We do a lot with Kris. We'll do a few more investment nights. You'll see us around the country again, hopefully. You've got the contact details, so please make sure if you any questions, email me, david.faulkner@pb.co.nz. And thanks for tuning in. Enjoy your evening. Atiwa.
Thanks.
Thank you.